Craig, since it's been a few weeks, what can you tell us wide swath about economic data that we've had printed, from non-farm payrolls to maybe Fed minutes or Treasury auctions, whatever you want to hit? Give us a little bit of a review on the past few weeks, and then what macro event risk is coming up, notably CPI on Thursday.
This short clip is presented by Edge. Edge is our pro-to-pro advisory service, which is all about the macro with a focus on one-to-one engagement with the hedge fund manager, Craig Shapiro, economics advisor, Jeffrey Fouvry, and direct access to LaDuc Trading founder, Samantha LaDuc. For more information about Edge, visit www.laductrading.com/edge.
So back to the June Fed meeting and dot plot. At the time, I referred to it as, or asked the question, was this the Fed's trichet moment? And what I meant by that was the Fed shifting hawkish right as the data in the real economy was rolling over? And I still think that framework is an accurate one. And basically what the Fed did at that June meeting was they removed cuts from the forecast for 2024. They raised their estimate for PCE. They raised their GDP estimates. And, majority of members are looking for only one cut this year. No, there's several at two cuts, but, really they moved in that direction kind of right as we've been noticing, more of a deterioration in the economic data. City surprise index is kind of making multi-month lows. And most of the data has just kind of come in a little bit softer than expected, to start July, data for the month of June. Then we had the payroll data last week in a holiday shortened and weird 4th of July week. And that data was okay. Top line number came in a bit better than expected, but it was kind of a mixed bag, a lot of government jobs, healthcare jobs and the like. And so I think there was this, some deterioration, but nothing too dramatic on the pace of deceleration. But the PMI data, manufacturing and services PMI, both came in reasonably worse than expected. And so, look, I think coming into today, where we had Powell speak, there was some thought that potentially he may up the dovishness, possibly talk up the idea of loosening sooner rather than later. But I didn't really think that was going to happen, and that's largely what he said today. And he actually went out of his way twice to say, "I'm trying not to make any statement with what I'm saying here today to markets." And so, look, it looks like the Fed is acknowledging increasingly that there is dual risks involved in their policy outlook now, right? They have to bring inflation down, but they also can't cut too soon because that might reignite inflation expectations. But they wait too long to cut, then some of this deterioration in data may get worse, and so that they may find themselves falling behind the curve, and the labor market could deteriorate more rapidly, and that'd be something that they would be concerned about. So, but Powell kind of threw a little bit of cold water on that and said, yeah, we know that, and we're watching. Let's see what happens. Let's see what happens with the CPI print. Now, back into the end of June, I had noted that there was going to be a significant liquidity drain coming out of markets as the TJ was going to build, and as the RRP was going to build, and bank reserves were going to get rinsed into quarter end. And that happened and didn't really have much of an impact on the S&P. Certainly it did have some impact on cyclicals and small caps and anything not Mag 7. But the idea, the strong July seasonals that everyone's been talking about, was going to make it hard for the markets to fall last week in a holiday shortened liquidity week, when not a lot of people are trading and vol's going to get sold. And so we largely have seen that, right? July, NASDAQ is up 15 years in a row in July, and we're up again to start this July. And I think that's a combination of a lot of things on redeployment of capital after, strong equity gains to start the year, and more money maybe flowing out of bonds and into equities, or out of cash into equities. And clearly there's a story amongst this big cap tech regime that is hard to fight. And there's plenty of FOMO, and there seems to just kind of continue to be rotation within the names. And one day it's Apple, and then one day it's NVIDIA, and one day it's Tesla, and one day it's Microsoft, one day it's Amazon, and we keep grinding higher. There's obviously been very sizable underperformance in anything not Mag 7 or some of these favored names, but I include Lilly and Costco and AMD and some others in that bucket of momentum stocks. But small caps have been underperforming, cyclicals have underperformed, regional banks have been underperforming, retail's underperformed, housing's underperformed. Anything that's tied to the U.S. domestic cyclical cyclical economy is doing what I would have thought, which is struggling because the economy is starting to slow and the long and lagged effects of monetary policy are starting to bite an increasing piece of the economy. And so that's the environment we're in. It's not having a negative impact on S&P because the S&P is getting those positive flows. And as more money flies into the best names, the most cash rich with the securest growth stories or AI or what have you, that just means less money for these other names. And so we're seeing that rotation continue. IWMs are there the brunt of that. And I think that's likely to continue. And so now we're in the middle of this week. Powell speaks again tomorrow. It's unlikely to be anything earth shattering when he speaks to congressional members. It'll be the House tomorrow. But Thursday is very important. Thursday is the CPI, and then Friday is the PPI. And the combination of that will generate that PCE expectation for the end of the month. I would say market is expecting a tepid CPI print for June. Look, I mean, if we get a tepid print, then it's going to be 2 in a row that would be considered cool. Not enough to bring forward probably a July cut, but there'll be people who will romance the idea of a September cut for sure.
Even before CPI comes out tomorrow, Fed funds rate expectation for
are there. We're there.
8%.
Yeah, the market is already at 2 cuts for this year. So that suggests that we're pricing in a cool number later this week. If we were to get a hot number, I think that would be a disappointment because we just had a cool number for May, then to have a hot number for June, that kind of makes it 2 quarters. Obviously the first quarter was no momentum, was no traction to getting back to target inflation. If June's a reacceleration of inflation and core and super core are very elevated, then the Fed would have to say, man, 6 months of the year, no real sustainable improvement. And the back half of the year, the comps are more difficult. So we're not likely to get there this year. We're going to finish the year PCE at 2.7, 2.8, which is where the dots are now. That means that we're not cutting, that the Fed probably isn't going to be cutting before the election. And I think that's not a good setup for what market participants are looking for right now. So I think a hot CPI is a risk-off event. A cool CPI, an inline to modestly cool CPI, I think is largely priced in. As you said, we're already kind of at the 2 cuts. And I think a ice-cold CPI, again, not expected. Maybe that would be considered bullish for risk because then you might get the odds of July creep up a little more. Again, I don't really think it's happening, but certainly the odds for September would probably go towards 90% plus. And that really makes it done deal.
The full episode is available to Edge paid members. For more information, visit LaDucTrading.com/edge.